had the Fed press conference today. They do this once a quarter, and they basically went through a litany of criteria that they're looking for, and I had mentioned a few that I thought were really important to see. And one was going to be the as someone had asked about the unemployment rate, how they saw the headline versus the versus what the real unemployment rate is, really kind of the labor participation rate plus the job quality. That was one of my criteria. The other was going to be the stall speed GDP that we have and weak durable goods, and also and this is, in my opinion, the most important hand tip that they showed today, was their target inflation rate, how the market has been responding to how if they've met their target inflation rate, and if not, how are they perceiving that? So I'm just going to go down the checklist of some of the notes I took in terms of the Fed, and then I'm going to discuss my take on it. So they basically said this: they see some progress. They see the economy expanding modestly. As I had mentioned, there's that stall speed GDP. We had a negative first quarter. So that is sort of off the table in terms of one of their criteria. They said unemployment rate is steady. It's about that 5 and change number, which is roughly full employment. But they went on to discuss the labor participation rate. Janet Yellen said it was a bit of an uptick, but realized it was sort of, I mean, not sort of, it's the weakest in 36 years. They talked about moderate household spending, although this number to me seemed a little bit disingenuous, because the numbers that have come in since their last sort of presser have come in rather weak, and I feel like the Fed almost was talking about older data. I'm going to get to that in a minute. There was one OMG moment I had, and I tweeted it out. They said the business investment is soft. That's the durable goods, which is weak. If it weren't for Boeing, that would have been a negative number as well. The exports are soft. That has to do with the strong dollar, so they're concerned about that. And the big Megillah was the inflation rate is below their target. They conceded that it's running below 1%, and their target is 2%. That is a ginormous miss in terms of Fed speak. I mean, that's like almost like a field goal kicker kicking it into the stands rather than looking to kick it into the in between the posts. So one thing that struck me, and I didn't really hear anyone talk about this other than me, although for some reason I seem to be the one who, I guess I have my ears tuned. They said that a lot of the inflation data, of the effects of lower energy prices, has yet to hit their data. So if that is true, they are well below their 2% inflation target, and they won't meet that, in my opinion, by the end of the year. There's a lot of talk about these dots and spots, whether or not the Fed is going to raise rates. Based on the data that I've seen, unless it dramatically improves over the summer, there will be no rate increase in 2015 and maybe none in 2016. I just don't see the economy improving enough to justify the Fed to go. If anything, they have a lot of excuses to hold back. The head of the IMF, Christine Lagarde, who's like BFF with Janet Yellen, I'm sure they do each other's hair when they're not out talking in front of cameras, made a request for the Fed to keep rates lower and not to go this year. I believe the World Bank is also chiming in now, saying that rates should be lower for longer. So if Yellen goes and the Fed decides to raise rates, they've been now warned by multiple, intergovernmental agencies that they can't go, and she'll have no cover if they raise and it's a debacle. Then she's going to be on the spit, so to speak. I don't think that will play out very well, and I'm not sure if Janet Yellen is going to want to kind of step out there alone like that. Chairman Bernanke has made some comments that were rather dovish recently. I thought that today's Fed statement was way more dovish than the media was giving it credit for. And I guess they forgot to turn the page or something, sort of toward the end of the day. They were still talking like the Fed presser hadn't happened. I mean, these people on TV are unbelievable. They just want to have that, the narrative. I guess there's nothing else to talk about other than that in Greece, and which is also, by the way, a huge concern for the Fed. I believe the Greeks are meeting with Putin this week, so we'll see how that goes. I think that Greece will be a last-minute muddle-through deal. Maybe they'll get an extension on their terms. Eventually, they will default, in my humble opinion. I just don't know that it's going to be right now. Let's discuss. Is there anything more? I'm just looking through my Fed notes. I don't want to bother you guys with a litany of stuff. But the ones I mentioned are pretty important. They again, with the transitory weakness, the Fed has been wrong, honestly, the whole time with their growth forecast. It's consistently been weaker than they've expected. So I don't expect that to change. If we do start seeing some better improving numbers, then maybe I'll come back and revise my view. But the speech that Janet Yellen gave with today, the press conference, I think was about as dovish as it comes. I think they want to kind of try to keep the markets from boiling over and having some type of a blow-off crisis top, because once people realize that the Fed isn't going to raise rates, it's party time, right? So open bar. So they are just trying to kind of keep the wheels on the cart, so to speak, to avoid a 1929 type of blow-off scenario. Yellen was quoted recently as saying she thought stock prices are quite high, and she's correct. I mean, the market is trading anywhere from between 17 to 20 times earnings, depending on how you calculate it. And the one key ingredient that keeps getting left out of that discussion is that interest rates are lower for longer. And Janet Yellen made it clear in her speech that, and I mean, she said this now a few times. I guess it takes a little time for it to sink in. I think you have to tell people eight times before it really sinks in. But let's say that the threshold for interest rates is up here at about 6%. They basically went out and said that they're going to normalize at about 3.5% or so. So the trajectory for rates is going to be slower. And they also, I believe, I had written an article for TheStreet.com, which is Kramer's website. If you take a look, I'll post the link on the rebroadcast of YouTube. I also posted it during the day today. I said, read this. It's an article about the Fed. And it was search engine optimized, and it discusses Apple, but it was really an article about the Fed. The original title for that article, by the way, was called Shadowboxing the Fed. And then it became, Apple is gaming the Fed, interest rates or whatever. But it's really, the real title for that article is Shadowboxing the Fed. And I think if you read that, you'll really understand where my head is in terms of what interest rate policy is going to be, as well as where I think the Fed heads are going to be in the end. It's sort of where the puck is going, not where it is now. I think that they want to talk tough, and maybe they want to raise interest rates. But the truth is that the government is issuing huge levels of debt. You have the unknown effects of Obamacare. Greece is looming. Europe is, kind of not doing so well, muddling through. Things are not going well here. I mean, one more negative GDP print here, and we're technically in recession. So that's really, I think Yellen put on a brave face today, but I read through read through her cool, calm, austere, and I saw that I think she's afraid of recession. And if that happens, you're not only going to not see interest rates rise, you're going to see more QE, because that's all the Fed knows how to do. They know how to raise rates, and they know how to print money. So that is my view on the Fed. I don't know what they'll call it. They will probably not call it QE because it's politically incorrect. A couple of years ago, they had this Operation Twist, and maybe this will be, Operation Tango or whatever they want to call it. It's really just Operation Dancing with the Stars, and they're going to keep the plates spinning for as long as it takes. So a lot of people think, but one more thing, and then we're going to go on to some stock-specific stuff, I guess. The real fear, everyone keeps talking about, inflation. The real fear is not inflation. The real fear is deflation. And once you get a deflationary spiral going, it's very hard to stop it. As the Fed has learned, they had to go to extraordinary measures with QE. If you're raising interest rates, that quells and crushes inflation very, very quickly. So their real fear, I don't think, is moving too late, because they can always make up for that in the back end, so to speak, with, I guess, steeper increases. But it's really moving too early and having a 1937 style scenario where the economy started looking better in the Depression, and then it became a recession within the Depression because the Fed started raising rates too soon. So I believe the Fed is going to want to see multiple data points before raising rates. They're going to want to have Greece resolved and a few other loose pieces of loose change. And I highly doubt that they're going to want to raise rates in a non-press conference event. And that, to me, would mean that they'd have to move either in September, or they'd have to, I think, wait until next year. And I can't really see them using 1 quarter's worth of data to end policy that has been in place, for the past 6 or 7 years. So that's my opinion, lower for longer. Fiscal policy. Yeah, the Fed, you're right. I've said that the Fed is the adult in the room. We have an absolutely incompetent president, in my opinion. We have a Congress that is basically also fairly not so competent, and I believe that the Fed is kind of did keep the wheels on the wagon when things were going badly. So, not to be too political, if you must know, I do tend to lean toward the Republican side of the equation, but that's not this broadcast, and my market views are about making money, not about making political statements. But if I do have the opportunity to comment on politics and I'm asked specifically about it, I am not going to hesitate to answer. But yes, I believe the Fed has been what's kind of kept the wheels on the wagon. Yeah, it's a contrarian call. I know. No rate hikes through 2016. If the data stays where it is, if it does not improve from where it is, yeah, there's nothing for them to hang their hats on. The Fed's mandate is full employment and to keep inflation down. And there's no inflation. If anything, there's disinflation. Yellen made one comment, and it's something I've discussed. She talked about where was it? She was talking about credit availability and how it's not. This is really what really causes interest rates to rise, is the demand for money. And she was talking about a contraction in credit availability as well as sort of a low demand for money, which is, as we all know, is the same side of the same coin, as is under capacity utilization, as is. I'm drawing a blank. I guess it's been a long day. I've been going on and on about this. But under capacity utilization and a slack in demand, or a easing in demand, is what technically usually causes inventory recessions, and that also is the same side of the same coin. That is a little bit less of a problem these days than it has been in the past because of real-time inventory management. Companies have gotten a lot more efficient with managing their inventories, so the chance of an inventory recession, so to speak, is a little bit. I wouldn't say it's impossible. It's very possible that companies miscalculate and they overproduce and they're stocked up and they have to start discounting, but it's a little less likely than it has been in the past. The real concern I believe the Fed has here is and the one that I see as their big problem, is the lack of demand for money and the overreaction of credit facilities, the quote unquote tough credit standards. Before the wheels really came off in 2005 and 2006, Rome was burning here. They had these ninja loans. You had janitors buying multi-million-dollar apartments with no money down and not having to show financial statements. It is now the complete opposite. I recently bought an apartment a little over a year ago, about 18 months or so ago, and it was very, very stringent standards, checking financials and going over data. It was just like overkill. So I think that is the real issue for the Fed, is to try to coax institutions into lowering their lending standards a bit, but still maintaining enough discipline so that the wheels don't come off again, and we don't find ourselves in the same crisis that we found ourselves in 2008 and 9. When you know that's happening is when there's a lot of packaging and securitization of loans, and the discipline that took place back then was they just wanted to get these loans out there so that they can package, securitize them, and sell them. And that's really when the lending standards came down. You don't really see that anymore. I know a lot. Here's another contrarian view I'm going to throw out there. A lot of people are all saying, oh, you have to buy the banks and to buy financial institutions for a rise when interest rates rise. But these institutions have been so badly handicapped by regulations that they're almost utilities. And yes, their their prospects for, I guess, higher profits are there if there is a steeper yield curve because they borrow cheap and lend expensive. But there are other type of activities that they were doing, like proprietary trading and really running their prop desks, have been so hampered that I can't see them making the kind of money that they have made in past recoveries. So I think the playbook that people are using are a little bit outdated. It's almost like buying them as utilities. Speaking of which, there's an interesting chart that I think that you guys would behoove yourselves to checking out, and it's one that someone was discussing on the stream with me this week. They were talking about Procter & Gamble. And I know that's not a sexy stock, and I don't want to spend too much time on it, but I just want to use it as an example because I think it's a big company that we all know, and the stock is down a lot off of the highs, and a lot of the decline has been due to interest rate fears, and the stock is trading with a 3.3% yield now. But the part that's crazy is that they make toothpaste and toilet paper and non-growth businesses, and the stock is trading at 20 times earnings. So this to me is just case in point of the reach for yield that people are so desperate for type quote unquote safe investments in bond equivalents that they've been sort of stretching, and that this has of course come down now as the prospects for interest rates rise are higher. I do believe interest rates are going to rise over time. But if the economy gets bad, it's been a one-way trade for a while. It was a one-way trade for a while where people were buying bonds, and now they're all bearish on them. So it would not shock me to see some type of a little bit more of a bounce in terms of the TLT a little bit higher. I do think, of course, over a long enough period of time, rates will eventually rise because there is a zero bound. But I don't know that it's going to be the type of increase that people are so afraid of. Let's discuss some of the stocks that you guys had asked me about. So let's start with Twitter, since that was like a big deal this week. So we all know that Dick Costolo is out. Jack Dorsey is in. He was one of the founders of Twitter. Yesterday there was a bit of a reversal low. So my opinion on Twitter is that it had a reference low at 34.62, and as long as it's over there, it's sort of treading water and quote-unquote okay. I believe the low of 33 half-ish is a good reference stop, but for the stock to really go higher, it needs to take out the Costolo spike high. The problem for that is it's sort of a country mile away. It's up at 40.45. There's been a lot of discussion on the Twitter stream, particularly I had one conversation actually last night with Kramer. Actually, we were debating a little bit on the Twitter stream, and he said, he rarely disagrees with me, but this is one time where we do disagree. Jim was talking about Google buying Twitter, and if Google buys Twitter, Twitter will obviously will go higher because it's being bought, but that Google would go higher too to 700. I think that Google would actually likely go down on the deal. I think Google's a little bit beleaguered by the EC, the European Commission trying to break up Google, and I feel like investors are afraid that it's going to be sort of what happened to Microsoft. So Google might be a little bit dead money for a while. I'm not necessarily, I wouldn't say really bearish on it, but I'm not really that bullish on the stock at the moment either. The longer this goes on, of course, the cheaper it gets, because they do have a pretty solid earnings stream, and I believe that the move to advertising online is going that way. Although a lot of that is going mobile, and I'm going to discuss that in a minute with Facebook. But let's finish up with Twitter. So the fundamentals at Twitter and at Google, believe it or not, are both deteriorating. Google is losing market share to Facebook. Facebook is growing their top line faster than Google, meaning they're growing their revenues faster. They're taking share. and they're also kicking their front teeth in with regard to mobile. Facebook mobile is doing very well. It's a little bit lower in terms of their revenue than online, but it is kind of kicking butt and taking names with regard to market share. They're also going to start monetizing Instagram, and I believe that once Snapchat comes public, and the CEO said that they will be, it's going to show just how cheap Facebook kind of stole Instagram for. I've heard valuations of $37 billion. I mean, Facebook paid $1 billion for it, so it turned out to be a pretty good deal. And I know that platform, excuse me, there's a lot of fear that the youth are kind of leaving Facebook, but they're on Instagram, which is now a Facebook property. So I believe that the service of Instagram is going to expand, that it's going to be able to do more, and it's also going to be a good advertising mechanism and revenue generator for Facebook. With regard to Twitter, I think that eventually they should get it together or they're going to get bought. The problem is, will it be at $15 when it gets bought and sold for $30? That I don't know. I don't think it would be a bad acquisition for Google longer term, but I don't know that it's at this price, if that would behoove the Google stock price, so to speak. So I remember Google paid at the time, considered paid up for YouTube, and the stock languished for quite a while because of that. So maybe there's some type of fear with that with regard to Google. What else? Someone asked me about GoPro. So I'm not a huge fan of the management of this company. I don't like that they unlocked shares and that they the owners were selling or they were issuing more. It rubbed me wrong that they did that. They got that unlock done ahead of time. And I was actually really bearish on FireEye for a while too, for quite a long time, because they did something similar, although I flipped on FireEye. I'm actually fairly bullish on FireEye right now. I'm going to talk about that in a minute. So I don't, like I said, I don't love the management. I don't really think the product at GoPro is anything particularly special. I think that they, I think that Apple will come up with something. That Xiaomi, that Chinese company, is coming up with something. So that is sort of my opinion on GoPro. However, if the stock is, as it is now, is above 54.06, it's making higher highs and higher lows. The stock can probably bounce a little bit more, maybe into the low 60s. That's really where the real breakdown took place, so there might be a little bit more upside from here. The real breakdown took place at about 67 or so. That's about a 50% fib, so maybe there's some movement up there. We've kind of reached my target, though, like I said, the low 60s. So I'd be a little bit careful jumping in here. If you're kind of late to the party with this, or if you're looking for a stop, if this starts getting below like 55, 56, it's probably retraced more than you want to see, and I would be really cautious around there. Someone just asked me, so let's talk about some stocks I do like. So I like FireEye. Someone had asked about that. I like all of those cybersecurity stocks. I don't necessarily know that if you're not long FireEye already, that you should pile in here. It's up a lot, multiple days. I believe the stock can. I believe that the stock can run even still higher, but I never like to chase at the highs. You know, I sort of like either I'm right or right out at the breakout point, which was in the 46s area, which has not been retested, by the way. So if they have a bad quarter, or if there's some type of a drawdown in the market, maybe we do come down a little bit lower to retest that area. But after multiple days up like this, I would probably want to give it a little bit of time to pull back before I would be a buyer in the stock, you know, to first initiate here. That Palo Alto is another one. I discussed that in my, it's also kissing kind of the channel high here. So is FireEye. FireEye is a little bit below it. Palo Alto is a little bit closer. I had discussed that Palo Alto has a long history of bouncing off the 50-day moving average, which is currently about 158. That's a pretty far up point off. I don't know if it necessarily gets back down there or if the 50 catches up, but right or right out for Palo Alto, which is PAN-W off the 50-day moving average, makes a lot of sense to me. CyberArk's a little bit of a different story. It's a really, really expensive company with a very small share count, so I am bullish on this stock. I would just say just be a little bit careful on that one because it could be a little bit more whippy. It finally kind of played catch up to its bigger brothers the last couple days, and now it's up over 70.48. To me, is still bullish. If it gets back below there, it's a little bit more iffy. So that's the key level there. Another stock I really like, and it's sort of my go-to stock with regard to biotech, is Gilead. They had spent a lot of time kind of languishing in the hinterland, so to speak. And I actually had discussed playing the stock both short and then flipped long. So I am pretty bullish on the stock, but again, it's really run a lot. Are you getting great trade location first buying it here? I know a lot of people had 115, 120 call spreads on, so that might hinder the stock a little bit up there. But I do believe that there's room for some upside. I will discuss some Fibonacci extensions on that stock in my weekend video. I think I've shown them before, but the big one is coming up at 122.33. That's the 1.618 fib extension. It's also the top of like the recent sort of up channel. So yeah, there's definitely room in Gilead to the upside, but I would be more of a buyer a little bit on a pullback. If you're first initiating here. So notice my theme. I don't like chasing, particularly on a market that's not trending. That's key to this tape. We are not in a 2013 where the market is trending up. We are in a sideways choppy market with a lot of like very large retracements. And when that happens, I always say to do these three things. So one is to play for shorter time frames, meaning if you're looking for a swing, you might want to only play for a couple of days rather than like a week, for example. If you're looking for a 10-point move, maybe look for a 3-point move or a 5-point move, like shorten your swing, so to speak. I feel like I'm teaching golf here, right? Shorten up your swing. So shorten the swing, and then also you want to kind of aim small, miss small. I guess keep your stops tighter than you might normally. Be very technical. The market has been very responsive. We're in a responsive market. It responds to technicals as opposed to being initiative, which means it sort of goes after those technicals. There's buying and selling at highs and lows, and it's all being batted around in the day time frame. So that's sort of how I'm seeing the market and how to trade the tape that we are in, not the one that we want. So I think that kind of sums it up with regard to those. Apple still just in this sort of consolidation phase. I think that the stock is just kind of pinging the range. It's sort of got lows and highs, and I'd be looking for a bit of a buy down sort of near the lows, like close to the one. Let's see, the channel low now is around 121-ish, which is also the old low. So anywhere in the low 120s, I think, is a buy. And then you kind of want to pump it out in like the low 130s, low to mid 130s. Do I use a filter? Not so much. I once in a while do some scanning in the market, but the kind of stuff I scan for really is more relevant when there's been a big correction, like a drawdown. I start getting my analyst hat on and start looking at what's too cheap. The truth is a lot of stocks are fairly, expensive at the moment, and they've all moved a lot. So the scans don't necessarily come up with the kind of criteria that I might normally look for. So what I do is I look for relative strength in themes, like FireEye, for example. There's a ton of the news cycle, the news flow is on their side. Excuse me. There's been a lot of cyber hacking and break-ins, and that is sort of a big theme. Another theme is these body cameras. So like I've been fairly bullish on Taser. Anything above 35 I believe is still pretty strong. Absolutely would be a buyer of dips on that. Multiple year themes that aren't going to be affected by a bad economy. You have a lot of social unrest. You have a lot of kids filming their cameras, filming the police. So I think the body cameras are going to be a big thing. So airlines. Someone just asked me about airlines. That's a big, the themes in the groups. Facebook obviously is one I'm a big fan of. I think the stock eventually gets to 100 for some of the reasons that I had mentioned. So Ambarella, that has been up ginormous. If you want to first start buying it here, I think you're a little bit late to the party. It's been up a lot on a squeeze. Sure, it can still go higher, but I would be more of a buyer on dips at like a trend. The stock has kind of just gone full hockey stick. Trying to pick the top of something like that is never the easiest of endeavors, but I think first chasing here, yeah, you might be right for a couple of days, but I think it'll start getting a little bit dicey if there's any type of a pullback. You know, that squeeze will end eventually. They don't really have numbers coming up. They had their earnings already, so I guess it still can go. But if you're looking for something that's sort of, I guess, Momo-y, I would prefer Tesla. I'm a fan of Tesla. It actually got right up to about where I thought it would today. I've been saying I thought it would go to 265 again. We got to 264.36 and backed off a bit, but we still closed over the previous swing high of 257.74. So I believe that Tesla on dips, not chasing, of course, is going to go back and retest the old high and is probably going to get a Fibonacci extension higher. I don't have that drawn out on my chart here for whatever reason, but that will be in Sunday's video. Stay tuned. It's going to be a pretty bold call on where I think Tesla can go. They tend to be fairly bullish in the summer as well, so it's sort of seasonally good for Tesla. I think it peaked out around the horse show, which is sort of the end of the summer. So I think that Tesla probably has some legs to it. It's probably also a short squeeze. They have the Model X coming out. It's a little bit overbought in terms of the stochastics, and those are starting to bend back down. So it might be a little bit late if you're first like chasing up here in the 260s to 265s. But if there's like a pullback into like the, I don't know, like 240, somewhere between 225 and 238, that area could be a good right or right out type of a play on some type of a pullback. I'll discuss that a little bit more in the weekend video when I can show the charts. So airlines, that is one that I had done, I almost forgot about. So I believe oil is going higher, and that is, I think, the reason why airlines have been a little iffy. Oil's just been consolidating and chopping here, but I think it's going to see 67.34, which is the 38.2% fib retracement, and I think it's going to actually even get to 75, which is the 50% fib retracement. That just seems to me to make a lot of sense. It's just been kind of chopping here. There's been a lot. The Saudis are not cutting capacity. They announced that. But the oil rigs are shutting down at record rates, and I think that there'll be a response in terms of supply to the lower price of the commodity. So I believe that the price of oil is likely going higher, which is good for Tesla, by the way. Not so good for airlines. Delta looks like a pretty large top. It broke trend. The key level there is 38.12. That's the 61.8 Fibonacci retracement. I think that that's a good area for a good right or right out type of a trade. I would get a little bit more interested in this stock if it started to fill some of these, well, I guess it filled one of them. If it started to fill some of these lower gaps in like the mid-30s, like 36-ish and then 33-ish, there are gaps down there. 34.60 is the 78.6. So somewhere in the mid-30s, I do think that this is going to kind of bottom out. I'd be a put seller actually down there. That to me would make a lot of sense to sell some out of the money puts down there, or if you want to nibble on shares. I just need to plug my phone in. The battery's dying. There we go. So that's my thoughts on Delta. JetBlue is a little bit more bullish, but starting to make lower lows and lower highs. So I'd be a little bit careful. That stock has run a long way. I do think that that's a sort of BTD stock, maybe a bit lower. I'm going to do some Fibonacci workups on that as well. I'll discuss that. I'm going to do some how about we do some airlines in the weekend video? Do you guys like that? If you do, just tap the screen and we'll see some. It'll show some hearts. By the way, if you like anything, I'm not a really big fan of the heart situation here, but it lets me know what you're interested in. So if I'm talking about something that's boring you, just don't tap. If I'm talking about something that interests you, just tap the screen. I'll see the hearts. I know people are interested, and I'll continue and elaborate. So that could kind of, I guess it's sort of like the applause meter, right? So to speak. So just a preliminary look. I'll just do the fib quickly on JetBlue because I'm actually curious about this because I'm looking to actually buy the stock myself. So off of a 938 basis as the Fibonacci low, and if we use the recent high here of 2040, the 50% fib is roughly around the 200-day moving average of at 1589, and the 61.8 is around 14.35. The breakout was like roughly around 13, so I will start getting bullish on this stock to look to buy the tips in the lower teens. I'd be selling some out of the money puts and looking to sort of initiate a starter position down there, and just, I guess, waiting for some type of a reversal bar to play against, like to, let's say it gets to 61.8 and it forms a hammer. That low would be a great reference point to play off of. So I usually like to do size, right or right out, particularly at 61.8 Fibonacci levels. Sometimes they're violated in between. I have not noticed, a lot of people get a little bit bearish if something like that happens. If the 61.8 is violated, they sort of see it as, the must-go level, but I sort of use it more as a range. If there's some reference areas in there, sometimes it'll initially go through. But yeah, I think somewhere between that 14.35 and that gap fill where this sort of where the big move took place in the 13s, that area, it's a big move down from here, but I'm sort of a bit of a perfectionist when it comes to levels. I really am very particular about that. If I don't have something really technical to base it off of, I get a little bit iffy. So if we do get down there, I would be interested. What percentage of your actions are based on technicals versus fundamentals? I'm going to answer that question, and I think we're going to wrap up with that question. So that'll be the last one. The answer to that question is it varies. Different points in the market. If we're after a very deep market correction, I will be more fundamental than technical, believe it or not. I'll start looking at book values and dividend yields and valuations. I get very analytical. It's sort of like almost like a throwback to my college days. When we're in a trending or sideways or responsive type of a market like we're in now, I am much more technical. The technicals always show the kind of the moves before the fundamentals sometimes. The fundamentals, believe it or not, are always there. It's just a matter of you might not know it but the stock may have already moved before the fundamentals are known. So I would say that I'm probably, if I had to percentage weight it at the moment, I would say I'm probably about 65% or so, 70% technical. And then you could split the balance between fundamentals and macro. Obviously, macro is very important right now with Greece, so that's probably edging up there a little bit more than normal. When most people talk about macro, it's a little bit differently than I do. I sort of look at macro as my outlook on money supply and how much margin is available. And the Fed has had interest rates so low, so that hasn't really been so much of a problem. It's been sort of more the technical and fundamental stories of individual stocks. The macro really gets important when the SHIT hits the fan. So that to me that's how I kind of use my blend, so to speak. But that'll vary at any time. Actually, a lot of I'm going to launch a subscription service. When I do that, maybe I'll have an indicator at some point about like my percentage that I'm weighting on any given thing, with technicals or fundamentals versus macro, and which is maybe weighing a little bit more on the market at the time. So that's my theory on that. I know there was something else I had wanted to discuss with you guys and girls, but I forgot what it was. There was like one more issue. It'll come to me, of course, after we're done. Anyway, let's wrap it there. Thanks so much for tuning in. There will be a rebroadcast if you came in late on this on my YouTube channel. That's Justin Pulitzer Trades. There's a link to that in my Twitter profile. If you're not following me on Twitter, the handle is @JustinPulitzer. Be sure to follow me on there. And I'll post an article to that Fed article I wrote, and you'll see that in the rebroadcast of this. I'll probably have the rebroadcast up tonight at some point. Anyhow, thanks so much, and cheers.